Identifying market overbought and oversold signals using the relative strength index indicator, the RSI. Understanding the RSI indicator signals. The RSI is a market momentum leading indicator tool that gauges in real time the extent of how far bullish or bearish price has gone in the bullish or bearish direction, and how much further price can continue before a reversal or a turnaround occurs. It measures the price overbought and oversold in the market. Components of the RSI indicator. The RSI indicator is made up of 4 major components, which includes the 70% mark or line, the 50% mark or line, the 30% mark or line, and the moving average line indicator. The illustration or diagram shows the 4 major components of the RSI indicator and their relative positions. Okay, we have the upper horizontal line, which represents the 70% line or 70% mark of the RSI indicator. Okay, this line gauges the degree of price movement in the upward direction. It is also used for gauging or measuring the market overbought condition. We also have the lower 30% or 30 mark line. Okay, this line measures or gauges the degree or extent of price movement in the downward direction, and it also measures the degree of price oversold or the market oversold condition. Between the 70 and 30% mark or lines is the 50% mark or line of the indicator, which measures the bearish and bullish conditions of the market. Okay, and we also have the MA line or the moving average line of the RSI indicator, which is sandwiched between the 70% line and the 30% line of the indicator. It represents the wavy line that moves and interacts with the various components of the RSI indicator. Its interaction with the various components of the RSI indicator determines the condition of the market. The overbought signal. This is the movement of the MA line of the RSI above the upper 70 mark line of the indicator. What is a market overbought condition? A market overbought condition is a situation where price has moved too far up in an extended bullish trend or a prolonged and usually exhausted bullish price rise that is due for a reversal or a bearish fall to the downside. This signal is usually characterized by the movement of the MA line or moving average line of the RSI above the 70 mark line and its subsequent retention above the 70 mark of the RSI. As shown in the illustration, we have the movement of the MA line or moving average line of the RSI above the 70 mark line and its subsequent retention above this line. Okay, this confirms an overbought market condition. Around the overbought region as depicted in the preceding section, when price is above the 70 mark line of the RSI, it is said to be overbought and due for a probable reversal to the downside. Hence, when the MA line of the RSI is above the 70 mark line, in order not to be caught off guard, a trader should be wary of executing a bullish trade as the sentiment is fast turning bearish and heavy executions or price moves that can easily move price in the opposite direction are underway. On the flip side, however, if the MA line of the RSI moves below the 70 mark line from the overbought region of the RSI indicator, it signals a powerful bearish price move or a bearish reversal in price, which by implication implies that the market condition has significantly changed or turned around from the bullish to bearish direction. So when the MA line crosses below the 70 mark line from the overbought region, it signals a bearish trend or a price fall. The oversold signal. This is the movement of the MA line of the RSI below the 30 mark or 30% line of the indicator. What is an oversold market condition? A market oversold condition is a situation where price has moved too far down a bearish trend or an extended and usually exhausted bearish price fall, and it is due for a reversal or a bullish movement to the upside. As shown in the illustration or diagram, the oversold is represented by the movement of the MA line of the RSI below the 30 mark or 30% line of the RSI and its subsequent retention below the 30 mark of the indicator. Around the oversold region as depicted in the preceding section, when price is below the 30 mark of the RSI, it is said to be oversold and due for a probable reversal to the upside. Hence, when the MA line of the RSI is below the 30 mark, a trader should be wary of executing a bearish trade, as the sentiment is fast turning bullish and heavy executions or price moves that can easily move price in the opposite direction are underway, and price may not have enough juice to continue moving in the bearish direction. On the flip side, however, when the MA line crosses above the 30 mark or 30 mark line from the oversold region, it signals a powerful bullish price move. Okay, So when you have a signal like this, where price or the MA line of the RSI moves from the oversold region and above the 30 mark or 30% line of the RSI, this is a powerful or strong bullish signal, usually a bullish reversal or a turnaround in price from a prior bearish trend or fall to move in the upward direction. The 50% mark or line. The 50% mark or line is sandwiched between the 70 and 30 marks of the RSI indicator. What is the significance of the 50% mark? When the MA line moves above the 50% mark or line of the RSI, it is a bullish signal. However, when the MA line crosses below the 50 mark, it signals a bearish price move or market condition. The 50 mark or 50% line has bullish and bearish signals for trade execution. As shown in the illustration, a suitable signal for bearish trade execution is represented by the movement of the MA line or moving average line of the RSI indicator below the 50 mark line. Okay, the best signal for bearish trade execution is when we have the MA line staying between the 50 mark line and the 30 mark line. In other words, when the MA line of the RSI crosses below or moves below the 50 mark of the RSI and stays between the 50 mark and the 30 mark line, which is below, we have a suitable signal for a bearish trade execution. However, on the flip side, when we have the MA line of the RSI moving above the 50 mark line, or when the MA line of the RSI is between the 50 mark of the indicator and the 70 mark line of the RSI, it signals a perfect or a telltale signal for the execution of a suitable or an ideal bullish trade execution. So a perfect bullish trade execution should be taken or is taken when the MA line of the RSI indicator moves above the 50 mark line or mark and stays between the 50 mark line and the 70 mark of the RSI indicator. So most bullish trades are executed when the MA line of the RSI moves above the 50 mark line but stays below the 70 mark line. The moving average line of the RSI indicator. The significance of the moving average line. The moving average line or MA line of the RSI is the wavy line that is sandwiched between the 70 mark and 30 mark lines of the RSI. The interaction of the MA line with the various component parts such as the 50, 70 and 30 marks of the RSI signals or reveal the real-time state or condition of the market. When it crosses and stays above the 70 mark, we have an overbought situation, and the oversold situation is when it crosses or stays below the 30 mark line of the RSI indicator. So the MA line of the RSI indicator is the pointer to what the market condition or situation is, or the market status quo with relation to the RSI component it is in contact with. So the interaction between the MA line or moving average line of the RSI with the various components of the RSI determines the market condition or status quo. To have more of useful videos such as this delivered to you, simply hit the subscribe button and the notification bell. Thanks for watching.